Well, to take us through the company stories of the morning, James Gerrish from Shore & Partners and author of Market Matters joins us live via Skype. James, great to go and see you. I hope you're keeping well. Look, another positive start to the session following a pretty good advance from Wall Street. What's your early takeaway?
Yeah, morning to you, Scotty. It is a positive open to the ASX. It's some broad-based gains playing out across the market. I guess the only, it's being led by the IT sector. The more high beta areas of the market are doing pretty well, materials and the like, and it's only some of the more defensive sort of interest rate sensitive areas that are struggling a little bit on the market this morning. Real estate you made mention of. So yeah, a positive open, Scotty. We'll take it and we'll run with it.
Let's get through to some of the individual companies that have reported. BHP, a slight smidgen upgrade for iron ore, a bit of weakness in other pockets though. What's your general takeaway from the mining giant?
Yeah, they produced their December quarterly production numbers today ahead of their results coming in the back end of February. So the production numbers today were actually pretty weak, but they were well flagged in terms of the quarterly numbers that they talked about, or the guidance they provided for these numbers back in the September quarter. So, pretty much everything was down quarter on quarter. It was pretty much down year on year. But as you made mention of, Scotty, the important thing was that they maintained their full year production guidance. It's particularly key in terms of iron ore. It's obviously the dominant area of their business. It accounts for about 61% of their EBIT. So obviously that's very important. You also made mention of petroleum. There was a slight upgrade in terms of their production expectations in terms of that. So look, it was a good set of production numbers. BHP's been investing in new capacity over the last little while, and FY21 should be a year where, unlike Rio and Fortescue, that BHP actually grow their iron ore production going forward. So look, a reasonable set of updates today. You won't see any downgrades in terms of full year numbers coming out of brokers tomorrow. So I took it as a positive, Scotty.
Ansell is another company that has jumped out of the blocks. A trading update revising higher guidance, which is always welcome. It's pretty handy when you've got a pandemic and people are trying to be protected when you go and make protective gear, hey?
Absolutely, it's the place to be in. So as you made mention of, they came out with an upgrade today. The market was looking for EPS for the full year of between at $1.40. Ansell had previously guided to $1.35 to $1.45, so the market was already smack in the middle of it. The market was expecting 65 cents for EPS for the first half. They've come out and said they're going to do somewhere between 81 and 84 for the first half, but the second half is going to normalise. So you plug those into expectations, you get something like a 10% upgrade to full year numbers. I don't think the stock's doing as well as that after coming out. So the momentum is slowing. It's probably more of a short-term sugar hit in terms of Ansell's business. So you wouldn't plug it into your numbers on a on an ongoing basis. But clearly it's a positive. They've benefited from the pandemic, and I wouldn't be surprised to see the stock close somewhere up 3, 4, 5% on the session today. I don't think they'll experience the equivalent of a 10% upgrade that might have been thought of if you look at the actual raw numbers, Scotty.
Yeah, you can see the Ansell share price coming off those early highs, up about 0.3% now for the session. James, I mentioned about the update from Sydney airports. Now, it's no surprise, particularly given the domestic border shutters that we've seen around the country, and of course the international border is closed, that passenger numbers are down substantially. The one key thing when it comes to Sydney Airport, though, is when do we think we're going to start to see a normalisation in travel patterns? It's a $1 million or $1 billion question. Do you ever take there at Shores?
Yeah, I mean you're right. That's the tough thing, and I don't think we'll know because governments, don't know when travel restrictions are going to be taken off hold, particularly the experience we're seeing overseas. So obviously they had a brief uptick in their domestic travel coming in that window in December that we saw, where travel domestically at least was pretty free flowing. We know international travel is a long way away. So these numbers are poor for Sydney airports, but I think you've got to focus on the balance sheet they've got. They've got a good asset base, but again, I don't see the catalyst in the very near term. Irrespective of when domestic travel kicks up, for Sydney airport's earnings to really crank higher. So, to me, we own the stock in our income portfolios. We've bought it into reasonable levels into the pandemic. They've got a well-capitalised balance sheet, etc. But I think to me, it's a longer-term play. So I wouldn't be sitting here owning this stock, or we're not sitting here owning this stock thinking that it's going to turn around anytime soon. And of course, the other negative influence on Sydney Airport of recent times has been rising bond yields. Obviously, it's a yield play, it's an infrastructure play, it's this bond proxy. Rising bond yields, as we've seen, particularly over in the US, is a negative for Sydney Airport. So I hold it, Scuddy. We're up on the position, but I'm not expecting a lot from it in the near term.
Bit of a longer dated call option on the normalisation of travel, perhaps. Look, James Gerrish, Shaw and Partners, fantastic to go and chat. Enjoy the rest of your day.